Heya Cryptozens, it's 10 p.m. Pacific time. The date is October 8th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host as we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. Monday. On Monday, members of the U.S. Financial Stability Oversight Council, or FSOC, they recommended U.S. lawmakers pass some legislation to decide once and for all which rulemaking authority will take on the task of regulating parts of the crypto spot market. Jonathan Rose is a senior economist at the Reserve Bank of Chicago. So it was at October 3rd meeting that Rose said that the FSOC had released a report. This is one of the reports required by President Joe Biden's executive order on crypto. And this report details potential financial stability risks and regulator gaps. And so they identified gaps. And one of those gaps includes regulatory authority over crypto's spot market. These are spot markets for cryptocurrencies that are not securities. Quote, while some firms in the crypto asset ecosystem have attempted to avoid regulation, other firms have engaged with the existing regulatory system by obtaining trust charters or special state-level crypto asset-specific charters or licenses. The report recommends the passage of legislation in providing a rule-making authority for federal financial regulators over this spot market. So in Rose's view, crypto could present a real financial stability risk to the United States under certain circumstances. One of those, he feels, would present a real risk to the U.S., continued growth without corresponding regulation. He also spent some time talking about crypto firms that operate through affiliates or subsidiaries. The question is whether those kinds of services should be allowed to be offered through intermediaries, including broker-dealers and futures commission merchants. In a statement for FSOC, Treasury Secretary Janet Yellen said, quote, these reports provide a strong foundation for policymakers as we work to mitigate the risks of digital assets while realizing the potential benefits. They also provide a valuable addition to the public's understanding of digital assets. And it seems like the council is kind of leaning towards the CFTC, the Commodity Future Trading Commission, that the CFTC would be the one given regulatory authority over crypto spot markets. Congress has already introduced a few bills with the aim of dividing out those duties and responsibilities between the CFTC and the Securities Exchange Commission. Meanwhile, members of the industry have also criticized the two bodies for taking a regulation by enforcement approach to digital assets, seemingly in an attempt to gain regulatory control over the market without legislation going through Congress. Tuesday. The Federal Reserve Bank of New York issued a report. It's called The Financial Stability Implications of Digital Assets. And this report takes a look at the DeFi sector and at stablecoins. It gives something of an overview of stablecoins, looking at their broader place in the crypto ecosystem. And this report points to several features that, quote, introduce novel vulnerabilities to both crypto and traditional finance's stability. And their researchers made mention of, quote, significant financial stability implications. Another thing that they talked about was a comparison between Circle, which is collateralized by higher grade assets than Tether, at least according to Circle. But the Bank of New York would argue that traditional assets are also susceptible to volatility. We're talking about cash, commercial paper, U.S. Treasuries, and corporate bonds. And that's one of the things that they're concerned about, that liquidations and fire sales of even these traditional assets could have a huge impact on stablecoins. That despite being backed by traditional assets, stablecoins will still represent a lot of risk. Basically, their stance is that as stablecoins mature, any risk to collateral that props them up needs to be monitored. We've seen how even the safest looking stablecoins, trusted by millions of users, I'm looking at you, Tara, they were still influenced by big market moves. They finished off their report talking about a run on stablecoins. that such a run can cause problems for DeFi apps as well as the price of assets. Now look at the big players, Circle and Tether. They're both heavily integrated into crypto exchanges and the rest of the ecosystem. DeFi exchanges, lending platforms, derivative protocols. If they have problems, everybody has problems. Now, one of the things that they're suggesting to combat this are bridges, so that tokens can move from one blockchain to the other. I'm not a big fan of these, as they are often the weakest points in a hack. One of the things that the Federal Reserve Bank warns is that bridges can become a, quote, transmission channel for stress. They said, for example, users may address a loss of liquidity on one blockchain by transferring from another, leading to a cascading contagion over multiple networks. Bridges have also proved a key source of technical weakness as the targets of many successful cyber attacks. Now, staying on the subject of stablecoins, let's continue talking about Tether. Tether's chief technology officer is Paulo Ardoino. According to a tweet he put out, Tether has cut its commercial paper holdings to less than $50 million. As of September 30th, they increased their Treasury holdings to 58.1% of its total portfolio. The rest is reportedly commercial paper. And commercial paper is seen as less desirable and less stable than other debt instruments like U.S. Treasury bonds. Now, they said that their plan was to take Tether to zero commercial paper by the end of the year. So, in May, they had $20 billion in commercial paper. They reduced that to $8.5 billion by the end of June. Recently, a New York judge ordered an auditor called BDO Italia to produce financial records detailing the backing of Tether's stablecoin. Tether just announced that BDO Italia will be producing their regular attestation reports from now on. Wednesday. The Markets in Crypto Assets Regulation passed the European Council today, and it goes a long way toward making a more unified regulatory landscape in Europe. Once it goes into effect, then each nation won't be responsible for creating their own laws for implementation. Instead, this gives us the first ever licensing scheme for crypto wallets and exchanges across the 27 member countries. In addition, it also establishes reserve requirements for stablecoins. In an attempt to combat tax evasion and money laundering, a new law requires exchanges and wallet service providers to verify their customers' identities. Now, MiCA got its start in the European Commission. That was in September of 2020. From there, it was adopted by the European Council in 2021. And at that point, it focused on addressing sections of the crypto industry that aren't included in existing regulations. And officials and lawmakers have been working since June to resolve the differences between the two versions into a single legal text, which is what we have now. As far as stablecoins go, lobbyists were hoping that they could influence things in MiCA that they were worried about, aspects that would limit the trading of U.S. dollar-denominated stablecoins in the EU. Now, some of those hopes were dashed when the text of the law leaked a couple of weeks ago. The leaked text would later be rejected by member countries that were worried about a competition between a dollar-based stablecoin and the euro. Now, as far as the nitty-gritty goes, this regulation would require anyone who wants to issue crypto, they have to publish a crypto asset white paper. And as expected, stablecoins will have to comply with capital requirements. What this means is that stablecoin issuers will need to hold reserves to back the value of their tokens based on how much has already been issued. In this case, local authorities could raise those requirements based on how risky they think it is. So what happened today is that this text was signed off on by reps from the member governments in the European Council. And the text is sealed. It's expected that the text will be revealed by the EU's official journal before it goes live in 2024. Lawmakers at the Parliament will have to formally approve the text. In a letter sent to European Parliament's chair of the Committee on Economic and Monetary Affairs, they said that cooperation between Parliament and the Council should see the regulation approved on its first reading in Parliament. Thursday, Binance was granted a permanent license to offer digital asset services in Kazakhstan. The AIFC Financial Services Authority granted them a permanent license to offer custody services and to run a digital asset platform in the country. This is the result of multiple memorandums of understanding and an in-principle agreement. At the end of it, Binance got their license. That means Binance has official status as a regulated platform in the area. Gleb Kosterev, Asia regional head at Binance, said that it was another example of Binance's commitment to being a compliance-focused exchange. And on the subject of Kazakhstan, Kosterev said, quote, "We welcome Kazakhstan's drive to become a leading player in the field of new digital technologies and the cryptocurrency ecosystem." The whole process got started earlier this year in the form of a memorandum of understanding back on May 25th. In that MOU, Binance pledged to further help crypto adoption and regulation in Kazakhstan. Another MOU was signed on October 3rd. This time, Binance vowed to help combat financial crime. And Kazakhstan by themselves, they've been making moves of late. September 28th, their president said that if there was sufficient demand, the government has a way to convert crypto to fiat. Given the number of Russians that are fleeing to the Kazakhstan border, that could become important because otherwise those Russians may not have a way of getting their wealth out of the country. And then last June, their Minister of Digital Development, Innovations, and Aerospace Industry set up a program. The aim of this program is to allow crypto exchanges to open bank accounts and run legal operations out of the Astana International Finance Center. When China banned crypto mining last year, most of those mining operations took up residence in the United States. However, Kazakhstan ended up being the number 2 destination. They had the second largest amount of refugee miners from China. As it stands, they maintain a solid reputation for crypto mining due in part to their low energy prices. In response to the influx of miners, Kazakhstan bumped up their power consumption reporting requirements and put in new tax guidelines that are expected to have an impact on the industry. Friday, the Reserve Bank of India, their central bank, has put out a 51-page document. This note outlines the potential features of a central bank digital currency as well as their reasoning for developing one. So they're trying to drum up support and awareness for CBDCs. 9 out of 10 central banks are working on one. And so they're working on the objectives and choices involved in introducing a digital rupee. Also under consideration are both the positive and negative elements. So this document talks about the key motivation for issuing an Indian CBDC. And they're talking about the key components of a sovereign digital currency. They brought up things like trust, safety, and liquidity, but also settlement finality. You have to know that your transaction isn't going to be backed out later. And integrity is a big concern, especially given the concentrated power a CBDC gives. So India has some decent reasons to be looking at digital currencies, although not necessarily central bank digital currencies. They want to reduce the operational overhead of maintaining physical currency. They also want an increasingly efficient payments system. Cross-border payments and settlements are also highlighted through the inclusion of an offline feature. And that is a big deal, especially in remote locations or areas without dependable mobile service and electricity. Electricity is a big issue in some places. So any kind of CBDC has to account for those requirements. And I see this as an advantage for crypto over CBDCs. If you're a central bank and you have physical cash-oriented system, as we do, now say you want to replace that physical cash system with something digital. That's all cool and everything until you start looking at a couple of aspects of physical money that's difficult to replicate digitally. One is privacy, not anonymity, privacy. If you know a payment was made, but you don't know who made it, that's anonymity. If you don't know a payment was made at all, much less who did it, that's privacy. And it seems like any kind of replacement for a physical cash system is going to have to account for that need for privacy. And then the second point, portability. I can carry physical cash all day long. I don't need a network. I don't need electricity. Those are two big issues I think CBDCs will need to solve before they can be considered as a replacement. Crypto doesn't have to do that. Although the ability to have private payments and the ability to be truly portable could be a huge advantage for adoption. As it sits, the Reserve Bank of India is only interested in CBDCs, not crypto. They still consider crypto a risk to their constituents. They said, quote, "These digital assets undermine India's financial and macroeconomic stability because of their negative consequences for the financial sector." They also worry about crypto sidestepping their monetary policy and damaging their monetary system. As has been done by many central banks, the RBI is trying to say that CBDCs are just as good as public cryptocurrencies. They claim they ensure consumer protection. Yet they claim that CBDCs avoid what they describe as, quote, damaging social and economic consequences. Frankly, I see that position as being so fundamentally dishonest, I would be leery of any claims to privacy or anonymity in any CBDC they develop, because it just won't be there. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. Take care of yourselves, but take care of each other too. We'll see you tomorrow night.